Freedom as a Fee, the Hidden Danger of Central Bank Digital Currencies, CBDCs. Summary Statement. As nation-states around the world accelerate efforts to digitize money, the rise of central bank digital currencies, CBDCs, presents a silent but systemic threat to civil liberties. Framed as tools of financial inclusion, efficiency, and innovation, CBDCs carry an embedded potential for surveillance, behavioral control, and programmable compliance. Unlike physical cash, which operates freely and anonymously, CBDCs allow governments to monitor, restrict, or even revoke access to funds in real time, based not on criminality, but on coded incentives and shifting political priorities. In this new model, freedom becomes conditional, and rights risk becoming subscriptions, revocable by algorithm. This essay explores how CBDCs could quietly transform the relationship between citizens and the state, turning foundational liberties, movement, speech, assembly, into privileges governed not by law, but by code. Section 1. Introduction. In an age where everything is being digitized, from work and healthcare to identity and communication, the financial system is undergoing its own quiet revolution. Central bank digital currencies are being rolled out, researched, or piloted by governments around the world, promising faster payments, streamlined systems, and greater financial inclusion. But behind this promise lies a deeper, less visible transformation. CBDCs are not just digital versions of cash. They are programmable instruments embedded with logic that can restrict, redirect, or even deny access to funds based on rules set by central authorities. Unlike cash, which is neutral and bearer-based, CBDCs are network-native, traceable, and subject to control at the code layer. This subtle shift carries profound implications, not just for economics, but for civil liberties. Money has always been a tool of power, but programmable money becomes a mechanism of behavior modification. In such a system, freedom can be throttled, delayed, or priced, one line of code at a time. This exposition explores the hidden dangers of CBDCs, not as an abstract future threat, but as a near-term architectural shift in the relationship between individuals and the state. From freedom of speech to freedom of movement and assembly, we'll examine how programmable money could make freedom itself subject to terms and conditions. When money becomes code, rights become permissions. When freedom has a price, we must ask, who's setting the fee? Section 2. The promise of CBDCs, what we're told. Central banks and state agencies around the world are quick to assure the public that central bank digital currencies are about progress, not control. The narrative is crisp, technocratic, and compelling. CBDCs will modernize the financial system, increase efficiency, promote financial inclusion, and give governments better tools for managing monetary policy in an increasingly digital economy. From the People's Bank of China to the European Central Bank, and from Brazil's central bank to the Reserve Bank of India, the messaging aligns remarkably well. We're not replacing cash, we're simply giving people more choices. At first glance, these digital currencies seem like a logical next step. We live in a world of smartphones, QR codes, and tap-to-pay interfaces. So why shouldn't governments offer a central, secure, digital alternative to physical cash or private payment apps? Proponents point to clear benefits: real-time payments without reliance on commercial banks or third-party platforms, lower transaction fees and settlement risk, especially in cross-border trade, greater financial inclusion, particularly in underserved or unbanked populations, faster stimulus delivery, as seen in pandemic-era proposals for digital helicopter money, tighter control over monetary policy, including the ability to impose negative interest rates or direct cash flows toward targeted sectors. In developing regions, the appeal of CBDCs often centers on building trust in formal systems and reducing dependence on volatile local currencies or cash economies. In advanced economies, the pitch often focuses on defending monetary sovereignty against threats from private stablecoins and foreign digital assets. On paper, CBDCs appear to solve a wide range of technical and economic problems. But what's less often discussed is what they enable, not in theory, but in design. Because when money becomes programmable, its use is no longer neutral. Every transaction becomes an opportunity to incentivize or penalize behavior. The true story of CBDCs isn't just about what they offer, it's about what they permit and what they could restrict. Section 3. Programmability. The feature that changes everything. At the heart of the CBDC transformation lies one powerful, under-discussed feature: programmability. Unlike cash, which is inert and permissionless, or even traditional bank deposits, which are relatively neutral, CBDCs can be encoded with rules. These rules can define how, when, where, and on what money can be spent. While that might sound like a feature reserved for smart contracts in the crypto world, it's exactly what central banks are beginning to explore, with real-world pilots already underway. Imagine receiving a government subsidy that can only be spent on approved food categories, or a stimulus payment that expires in 30 days if unused, or a travel credit that's only valid within your local district to encourage sustainability. With programmable money, these are not hypotheticals. They're built-in possibilities. Supporters call this a step toward targeted economic efficiency. It allows governments to fine-tune behavior, reduce waste, and enforce policy goals directly at the transactional level. But this same mechanism opens the door to a new mode of governance, one where economic freedom becomes a conditioned activity. Programmability enables not just suggestion, but enforcement. Not merely taxation, but real-time behavioral correction. Key attributes of programmable CBDCs include spending constraints, limiting funds to specific goods, services, or vendors; time restrictions, imposing expiration dates on balances or stimulus disbursements; location enforcement, using geofencing to restrict usage to certain areas; identity-linked logic, enabling or denying transactions based on user profile, score, or compliance. This is not theoretical. The People's Bank of China, through its digital yuan pilot, has already experimented with expiration-based incentives. Meanwhile, India's Reserve Bank has explored conditional disbursements in its e-rupee pilot, and the European Central Bank has left the door open for smart contract features in its digital euro design discussions. At this layer, the nature of money itself changes. It no longer functions purely as a medium of exchange. It becomes a medium of enforcement, quietly shaping choices, eliminating defaults, and rewarding or punishing behavior based on dynamic rules. As a result, the question is no longer just what money is, but who it serves, who sets its conditions, and how those conditions evolve over time. Section 4. Surveillance and Access Control. While programmability is the feature that changes what money can do, surveillance and access control are what change who can use it and under what circumstances. These capabilities are deeply embedded in the infrastructure of central bank digital currencies, even if rarely emphasized in public messaging. Unlike physical cash, CBDCs operate within fully digital, account-based, or tokenized systems tied to identity, device, and location. Every transaction can be traced. Every balance can be monitored. Every participant can be scored, filtered, or flagged in real time. Proponents argue this visibility is a benefit. Governments can detect fraud faster, prevent illicit financing, and increase tax compliance. But this same visibility also creates the conditions for financial surveillance at unprecedented scale. In a CBDC-based system, your spending history becomes a live data stream, not a private ledger. Your social and political behavior can be correlated with financial privileges or penalties. Your access to funds can be modified, temporarily or permanently, based on algorithmic determinations. Access control mechanisms allow central banks or delegated authorities to freeze accounts based on suspicion, protest participation, or non-compliance, limit spending categories based on health, emissions, or social activity scores, throttle withdrawals to manage liquidity or prevent runs, disable funds entirely in the name of public order, health, or misinformation control. This is not speculation, it's precedent. In Canada, during the 2022 trucker protest, the government invoked emergency powers to freeze personal and business bank accounts of protesters and supporters, bypassing traditional court orders. In China, participants in public demonstrations have reported that their digital health passes, used for movement and payments, mysteriously turned red, barring them from transport and access to public places. In the European Union, the architecture of the digital euro allows the possibility of user-level controls based on risk profiling and behavioral scores, as outlined in technical consultations. Financial censorship is no longer a theoretical risk. It is a live feature of modern governance. And in a CBDC system, where all money is traceable and programmable, enforcement no longer requires legislation. It just requires code. When combined with digital identity systems, biometric login, and geolocation services, CBDCs become the ideal enforcement tool, not just for law, but for policy, ideology, and narrative control. Section 4, Thought Experiment, Designing the Digital Cage with a Smile. Let's momentarily shift gears. Imagine you are a government, not malicious, just pragmatic. You don't want to ban rights outright. That would trigger resistance, protest, and global headlines. Instead, you want behavioral compliance without brute force. You need a way to make dissent expensive, inconvenient, or invisible. So you don't outlaw freedom. You monetize it. Step 1, Language Engineering. First, you reframe the goals. Surveillance becomes data-driven governance. Movement restrictions become climate-resilient zoning. Speech moderation becomes civic harmony protocols. Digital fences become green zones. Spending limits become wellness incentives. Words matter. The public accepts what sounds good. They fear what sounds honest. Step 2, Lock the gate softly. Now, introduce programmable money, your new instrument of leverage. You don't say, we'll block travel. You say, earn mobility credits by lowering your carbon score. You don't say, we'll silence your political views. You say, accounts spreading harmful misinformation may face payment restrictions for community safety. You don't say, you can't protest. You say, assembly in high-risk zones may incur congestion and security surcharges payable via CBDC. You don't say, we're banning red meat. You say, monthly red meat quota exceeded. Consider plant-based alternatives for a rebate. Every restriction is framed as a choice, every limitation as a reward opportunity. You're not censoring or controlling, you're nudging. Step 3, Let code do the work. The beauty of programmable money is you no longer need a cop or a court. The rule lives in the network. The penalty is automatic. The compliance is silent. A protester might not be jailed, but their CBDC wallet might quietly stop working. A journalist might not be silenced, but their rent and utilities could fail to process. A traveler might not be stopped, but their funds might no longer unlock at the turnstile. No violence. No paperwork. Just terms and conditions, quietly updated. Step 4, Outsource the blame. When challenged, you point to the algorithm, or the risk model, or the community standards. Better yet, outsource enforcement to private platforms or NGOs. That way, no one person or institution is ever responsible for the consequences. It's not censorship, it's policy enforcement. It's not a punishment, it's a security protocol. It's not control, it's convenience. Step 5, Normalize the system. Eventually, no one remembers life before digital fences. People adapt. They don't rebel, they optimize. Freedom isn't removed, it's rationed. And once a right is tied to performance, permission, or payment, it's no longer a right at all. It's a subscription. Control doesn't need to feel like force. In the CBDC era, it feels like UX. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5, From Rights to Permissions, the Redesign of Citizenship. For centuries, the core of liberal democracy has rested on the idea of inalienable rights, freedom of speech, movement, association, belief. These were not rewards for good behavior. They were guarantees. But CBDCs and the digital control stack they enable quietly invert this premise. They turn rights into permissions, conditional, dynamic, and revocable. In this new architecture of governance, your access to basic freedoms can be linked to compliance, scored in real time, and adjusted based on behavior, affiliation, or risk modeling. You're still free, but now freedom functions like a software license, tied to your account, subject to updates, and automatically enforced. Here's how the shift plays out across core liberties. Freedom of speech. In a CBDC environment, speech doesn't need to be censored directly. It can be priced out or penalized. Platforms labeled as misinformation vectors could lose access to payment rails. Individuals spreading disinformation may be debanked or throttled, not arrested. Financial incentives could be withdrawn based on speech-based risk scores. It's not censorship by law. It's demonetization by policy. Freedom of movement. With programmable CBDCs, mobility becomes a function of algorithmic trust. Spend permissions can be geofenced to enforce local travel only. Carbon quotas tied to CBDC wallets could limit flights or long-distance transport. Zoning systems like ULZ in London already create soft borders. CBDCs make them financial gates. In this world, your ability to move isn't blocked by a wall, it's throttled by denied transactions. Freedom of assembly and association. Gathering in protest? Supporting an unsanctioned cause. The risks become financial rather than legal. Donations to certain groups may trigger audits or freezes. Attending a flagged event could reduce your social or environmental score. Spending in politically sensitive areas may require higher verification or fees. Over time, people self-censor, not out of fear of jail, but out of fear their accounts may stop working. Freedom of belief and conscience. Belief doesn't require surveillance. Behavior does. And CBDCs track behavior by default. Religious or ideological communities may be flagged for non-alignment with state narratives. Financial habits tied to those communities could trigger deprioritization in public service access. Scoring mechanisms imported from ESG or DEI systems may silently shape who gets what. This isn't theoretical. It's already observable in adjacent systems in China, and increasingly in Western pilot programs framed around safety, equity, or compliance. The new citizenship contract. Citizenship, once defined by constitutional rights, is now reimagined as a performance-based profile. Obey the narrative, full financial access, deviate from the norm, gradual exclusion, complain about the system, flagged for risk mitigation. This is the gamification of obedience, encoded into your spending layer, and when that layer becomes the universal interface for participation, shopping, transport, communication, identity, then freedom becomes opt-in and always conditional. Section 6. Case Studies and Precedents. Though the full vision of a CBDC-driven control grid has yet to be realized, early signals are everywhere. Governments, central banks, and private platforms have already shown how digital infrastructure can be used, intentionally or not, to punish dissent, shape behavior, and enforce compliance. These aren't speculative scenarios. They've happened. They're happening. Canada. Financial deactivation without due process. In early 2022, Canadian truckers organized a protest against COVID-related mandates and restrictions. The government, invoking emergency powers, responded by freezing the bank accounts of protesters and even those who had merely donated to the cause. No court order, no charges, no appeals process. Crowdfunding platforms were forced to hand over user data. Financial institutions were instructed to flag suspicious activity. This marked one of the first public demonstrations of debanking as policy enforcement in a democratic country. In a CBDC environment, such action could be carried out instantly, without legislative cover and at scale. China, geofencing, expiry dates, and narrative enforcement. China's digital yuan pilot is the most advanced CBDC program in the world, and it already incorporates programmable features, expiration dates on certain stimulus payments to encourage immediate spending, geofenced usage, limiting transactions to specific cities or zones, QR-based health passes tied to digital wallets that can turn red, blocking access to transport and public places, often after public dissent. The message is clear: your money works when you behave. United Kingdom, speech regulation by infrastructure. The UK's Online Safety Act, passed in 2023, gives regulators broad power to police digital speech under vague terms like harmful content. Combined with government disinformation units, critics fear this creates a de facto censorship regime. Financial and identity data are increasingly linked to online presence, creating new choke points for expression. The rise of ULZ and congestion charges shows how movement can be taxed through automation, with payment infrastructure enforcing compliance. With a CBDC in place, refusal to comply with any number of mandates could result in a frictionless denial of service. No protests necessary. United States Disinformation Governance Board. In 2022, the United States Department of Homeland Security announced the creation of the Disinformation Governance Board, allegedly to coordinate counter-disinformation efforts. The initiative was quickly paused and later dissolved after public backlash. Critics likened it to a ministry of truth, citing free speech concerns. Though short-lived, the board exposed a growing willingness among Western governments to merge information control with national security mandates. While the United States has not deployed a CBDC, this episode demonstrated the temptation to centralize narrative control, often under the banner of public safety. The pattern emerges. What unites all of these examples is not the technology itself, but the underlying logic. Digital systems allow rights to be reclassified as services and services to be suspended based on behavior. Whether through money, speech, movement, or identity, the message is consistent. Align with the system, frictionless experience. Challenge the system, financial or digital exclusion. These early signals are not glitches, they are feature previews. Section 7. The Global Playbook: Incentives, Models, and Convergence. CBDCs are not emerging in isolation. They are arriving alongside a suite of interlocking systems that reinforce the same pattern of control. Digital ID systems. Many governments are simultaneously rolling out or mandating digital identity systems. These link your biometrics, device, health status, and financial profile to a unified login. In India, the Aadhaar program links identity to bank accounts and public services. In Nigeria, the NIN system ties telecom access to government-issued IDs. In the European Union, eIDAS mandates standardized digital identity across member states. Once your identity is digital and mandatory, your access to services, including money, becomes contingent on your profile. Social and ESG scoring. While China's social credit system is the most visible example, the logic is spreading globally through environmental, social, and governance frameworks. ESG scores are increasingly used to assess not just corporations, but small businesses and individuals. DEI, diversity, equity, and inclusion metrics feed into hiring, financing, and participation scores. Political alignment with dominant narratives may influence eligibility for platforms, funding, or even bank accounts. CBDCs offer the perfect enforcement layer for these systems. Behavioral compliance becomes spendable privilege. Climate credits and carbon passports. In the name of climate action, several governments and private institutions are piloting personal carbon footprint tracking. France has proposed mandatory carbon quotas per citizen. The WEF and MasterCard co-developed a carbon limit credit card prototype. Scandinavian countries are experimenting with climate-based taxes on food and travel. With CBDCs, these programs move from voluntary to enforced at the point of sale. The walled garden financial system. Taken together, these systems represent a shift from an open financial ecosystem to a walled garden, where access is gated by compliance and money becomes the interface of governance. This isn't a conspiracy. It's a converging policy stack. Once implemented, reversal is unlikely. Each layer makes the next more efficient, more normalized, and more difficult to question. The endgame isn't always planned, but it is predictable. Section 8. Resistance and Alternatives: Preserving True Sovereignty. The rise of CBDCs does not have to mean the end of freedom, but resistance will require foresight, courage, and the will to build and defend parallel systems. Cash as a lifeline. Physical cash remains the last widely accepted, anonymous medium of exchange. Defending its legality and accessibility is critical. Policy efforts must protect cash usage without friction or stigma. Merchants should not be penalized for accepting it. Citizens must be aware of its role not just as payment, but as protest. Cash is not obsolete, it's off-grid freedom. Bitcoin and bearer digital assets. Decentralized cryptocurrencies, especially those designed as bearer assets, offer a viable counterweight to centralized digital control. Bitcoin remains the most robust example: censorship-resistant, portable, and open. Stablecoins on decentralized rails, when unlinked from identity, can offer dollar access without CBDC compliance. Privacy coins, non-custodial wallets, and mesh networks can support underground or parallel economies. The challenge is adoption. The opportunity is sovereignty, legal and constitutional firewalls. Citizens must demand that CBDCs, if implemented, include hard-coded protections, anonymity thresholds for small payments, legal guarantees against transaction-level surveillance, prohibition of programmable restrictions without due process, clear redress mechanisms for wrongful account blocking. Constitutional lawyers, digital rights groups, and civil society must mobilize before implementation, not after. Technological alternatives. Privacy-preserving technologies must be elevated and normalized. Zero-knowledge proofs for private verification, decentralized identifiers, DIDs for voluntary identity use, community currencies, local tokens, and credit clearing systems, open-source wallets that resist backdoors and tracking. The tools exist. What's needed is infrastructure, education, and the moral clarity to prioritize freedom over convenience. Section 9 Conclusion. A choice of architecture. Freedom isn't lost, it's redesigned. Central bank digital currencies are often marketed as harmless upgrades, just one more step in the march of financial progress. But beneath the sleek interface lies a far deeper shift: the redefinition of what it means to be free in a programmable society. CBDCs don't need to announce themselves as threats. They don't need to ban protest, criminalize dissent, or build prisons. They just need to make noncompliance expensive, inconvenient, or invisible. That's the brilliance and the danger of code-based governance. When every transaction is traceable, every wallet is programmable, and every right is conditional, we aren't living in a free society with digital tools. We're living in a digital system where freedom is rented. This is not inevitable. The future of money and the structure of freedom is still being negotiated. The infrastructure is being built, but the defaults are not yet locked. That means we still have a choice. We can demand CBDCs with built-in cash equivalents, anonymous, bearer-style transfers, and strict limits on surveillance. We can defend the legitimacy of analog, cash, in-person interaction, local governance. We can build parallel systems, open, voluntary, and privacy-preserving. And above all, we can refuse to normalize conditional rights, no matter how convenient, clean, or green the interface becomes. Architecture is destiny. At its core, this isn't just about currency, it's about architecture. Do we want a future where rights are guaranteed by law, or one where access is granted by algorithm? The question isn't whether CBDCs will arrive. The question is what kind of world they will be wired to serve, and whether we still recognize the price of giving up something permanent in exchange for something programmable. Because once freedom has a fee, it's no longer freedom at all.